Welcome to this course on financial instruments IFRS 9. We understand that financial instruments are the lifeblood of the global economy, and it is essential for us to understand how to accurately account for them. And this course will serve as a basics and a building block for advanced classes. So basically, we'll be starting with what led to IFRS 9. And when you understand what led to IFRS 9, you appreciate the impact of IFRS 9 in the accounting and also in the finance world. So let's get started. Now, before we start, I'd like you to take a pause and try this. What do you think? It says here that what was the main cause of the 2008 global financial crisis? Is it low interest rates? Is it unpaid mortgages? Is it the collapse of Lehman Brothers? Now, I would like you to actually go through this, take your time, and you can come back to this later and answer it after we are through with this section of the course. Now, the essence of this is for us to be able to flow through with the content of the course and have an understanding of it so that you'll be able to apply it in the subsequent ones. So I encourage you to try and participate in all sections of this course. It is Ralph Waldo Emerson that said that if you learn only methods, you'll be tied to your methods. But if you learn principles, you can devise your own methods. Now, the essence of this course is to give you the required skills in order to understand the basics. And so once you have the required skills to understand the basics, it will be easy for you to navigate the advanced courses. And so this is very, very important for your understanding of financial instruments. So what led to IFRS 9? What led to financial instruments? It used to be that IS 39 was the major standard that addressed financial instruments, but there was a reason why IFRS 9 came into play, and so we'll be looking at that shortly. IFRS 9 basically stemmed from the global crisis that happened in 2007. You most likely experienced the 2007 financial crisis, especially if you're in the US, or you may have probably read it on the newspaper, or probably you even watched it on TV. Yeah, so basically what happened is so many people lost, so many investors lost their life savings because of the global financial crisis that happened around 2007 2008, and it was a big deal because the major driver of the crisis is actually financial instrument. What really happened was that mortgage banks in the US, especially in the US, were actually releasing mortgages to different categories of homeowners that were interested in getting a mortgage. And so they had different categories. They had those that are prime, they had those that are super prime, they had those that are subprime. So the subprime were the least set of people that could actually get a mortgage. And the category is essential because it helps the mortgage banks to actually determine who to give mortgages to. Now, so because of the boom in the housing market, the mortgage banks were releasing mortgages to different people regardless of their income, regardless of their ability to pay back. So because there were so many subprime mortgages, subprime means those that are unable to make payment, or that may be unable to make payments, that have high credit risk. Yeah, so the banks were releasing funds to all these subprime mortgages, and as a result of that, it got to a stage where many of those homeowners that couldn't actually pay for the mortgages, they had to let go of the houses. And because of that, there was a lot of supply of houses in the US, and because of the high supply, it's translated into a decrease in price of houses. And so even those that were able to pay, that's the super prime and the prime mortgages, those that were able to pay because they could actually acquire houses in the market for cheap, they also let go of the mortgage, because it doesn't make sense for them to be paying the high interest mortgage when they could actually buy houses at a very cheap rate. Yeah, so they let that go. And what majorly drove the crisis itself was the fact that before all that happened, investment banks, they saw that the housing market was booming. And so what they did is they approached the mortgage banks to say, oh, we want to buy these mortgages from you. And so what they did was to buy the mortgages, and then because they are investment banks, they have so many customers all over the world that are investors. And so they sold those mortgages as collateralized debt obligations. They sold it as investments to different investors all over the world. And so people are buying piecemeals of all those mortgages as investment vehicles. And so when they were buying it, they were expecting inflows from the mortgages paid by the homeowners. And so the problem started when the homeowners started defaulting. And because of that, it means that the investment banks will be unable to get cash flows that will be released to the investors. And so because of that, a whole lot of investors lost their life savings because they could not recoup the investment that they have made in purchasing the investment vehicles that they bought. And so that's pretty much what happened. And because the way IFRS 9 works is different from the way IAS 39 works. IAS 39 was in operation then, and what IAS 39 does is it tracks incurred losses. So instead of the investment banks to actually be booking provisions as they are seeing that many of those subprime mortgages are defaulting, they were not doing that, because under IAS 39 you don't need to project the default. You don't need to project credit losses that will happen in the future. You are only concerned about the credit losses that has happened. And so because of that, many investors were caught unawares when the bust actually took place. That is when the crisis hit, because people were giving up all the houses almost all at the same time. Then because house prices dropped drastically, people could not actually even sell. I mean, the investment banks could not actually even sell the houses at an amount that they bought it or they took it over. And so it became a very big deal for the investment banks, and many investors that invested through the investment banks lost their life savings. So you discover that the essence of IFRS 9 is to fill in that gap, the gap of making a too little too late provision of losses. Yeah, so what IFRS 9 introduces is that instead of us to wait until the credit loss happens, we book ahead of time. So the expected credit loss model that IFRS 9 introduces helps banks, helps all entities around the world to be able to make provision for credit losses even when the credit losses hasn't taken place. Yeah, so that's pretty much like a summary of it. So what I've done is to include two links that talks about the crisis that you actually enjoy. It explains the crisis, it talks about the players involved, and it's a very insightful video series that you'll be happy to actually watch. So you can take a pause and go through them, or take your time to go through them later. It's something that you'll be happy to go through.